All around the world, debt has piled up like mountains. The United States faces an unprecedented burden in its history, more than $38 trillion in debt. The European Union carries around $14 trillion, and Japan is weighed down by almost $9 trillion. From oil-rich Saudi Arabia to export powerhouses like Germany and China, every nation stands under crushing sums of debt. But there is a riddle hidden inside this story. If everyone is in debt, then who is actually winning? This is the point where money, power, and history quietly collide, an unseen realm, a complex structure. Here, nothing is as simple as it looks on the surface. Because debt is not just a burden. It is an invisible support in the construction of the modern world, a hidden framework beneath wars, economic swings, rises, and collapses. And when you dive into the layers of this architecture, an unsettling truth emerges. The world does not really owe money to someone else. It owes it to itself. Yet this does not mean everyone takes an equal share from this vast mechanism. Today, our planet is struggling under more than $315 trillion of total debt, a figure that is nearly 3 times the size of the global economy. How did we get here? The answer lies in a story written centuries ago. The idea of national debt did not arise with credit cards or digital banking. It took shape in the dark heart of war. In England, in the year 1694. England was at war with France, and its gold reserves were running low. The king turned to the merchants for support. In exchange for a steady stream of interest payments backed by future tax revenues, the merchants agreed to finance the crown. To run this new system, the Bank of England was established. This was a revolution. For the first time, the state gained the power to spend money it did not yet have. In return, the merchants received something of great value: the guarantee of the state, a promise that could be bought and sold. Thus, the government bond was born, a beginning for what would become the great financial system of our age. France followed this example. The Netherlands refined it. The newly formed United States adopted it to finance its revolution, and its expansion westward. Debt was no longer seen as a sign of weakness, but as a symbol of strength. To borrow was to gain the authority to rule. Once, empires conquered lands for gold. Now, they issued bonds for interest. Battlefields gave way to balance sheets. Centuries passed, and debt became the world's greatest export. The debt of the United States reached $38 trillion. Japan's debt climbed beyond $9 trillion. Global debt increases by about $1 trillion every 100 days. Every country is in debt. Every bank extends credit. Every individual, through taxes, savings, and pensions, is both a debtor and a creditor. So, who holds the other end of this curious chain? Let's start with the United States. Because America's debt does not belong only to America. It is spread across the entire world. Half of this $38 trillion is owned by investors. 2/3 of those investors are American. Banks, pension funds, insurance companies, investment funds, and, of course, the Federal Reserve. The remaining 1/3, around $9 trillion, belongs to countries across the globe. The 2 largest creditors are Japan, with about $1 trillion, and China, with around $800 billion. So the phrase "America is in debt to China" is true, but it represents only about 2% of this grand story. In reality, most of America's debt is owed to America itself. The Treasury issues bonds. Funds and banks buy them. The Fed buys them back, creating new dollars in the process. American citizens pay taxes. Those taxes turn into interest payments, and those interest payments flow back into retirement accounts, a cyclical story, like a hall of mirrors. And this cycle is not limited to the United States. It stretches across the entire world. Japan buys U.S. bonds. America, through the IMF, supports Europe. Europe provides financing to developing countries through the World Bank. Developing nations, in turn, invest their foreign exchange reserves into Western bonds, supporting advanced economies. It is like a global game of hot potato, except the potato is made of promises. Every country holds another country's debt paper. Every promise is backed by another promise, and there is only one rule keeping the table standing. No one leaves the table. But deep within this tale, there is a fourth power: the markets. Behind every government bond lies a giant organizational structure. Hedge funds, pension funds, central banks, sovereign wealth funds, they control trillions of dollars. The real power is in their hands. Who borrows cheaply? Who is forced to pay high interest? These outcomes are shaped by their decisions. When confidence erodes, currencies begin to collapse, governments fall, and economies can change in an instant. Democracy decides who comes to power. Markets decide who continues to exist. And now we arrive at the most influential actors in this system: central banks. Central banks do not simply manage debt, they create it. When the Fed or the European Central Bank chooses to buy bonds, they do it with newly created money. A liability on one balance sheet becomes an asset on another. Every unit of money in circulation represents a debt somewhere else. There is no such thing as debt-free money. Every banknote carries a hidden trace of debt upon it. For decades, this cycle has continued, sustained by confidence. As long as investors believe governments will keep paying interest, the process goes on. But what happens when confidence fades? History has provided the answer many times. In the Greek crisis of 2010, debt became unpayable, bondholders panicked, and interest rates soared. The European Central Bank and the IMF stepped in, but their rescue package came at a heavy price: tax hikes, austerity measures, and unemployment. For an entire generation, the word bailout became synonymous with sacrifice. In Argentina, repeated defaults turned debt into a national curse. In Sri Lanka, when foreign debts could no longer be paid, the country faced fuel shortages and political collapse. When the system breaks, creditors suddenly become visible. The IMF, rating agencies, anonymous bondholders, the invisible powers encircling nations, and yet, even after collapse, the same story begins again. Old debts are wiped away, and new ones take their place. The cycle continues, because in the modern world, debt does not exist to be fully repaid, it exists to be rolled over. Governments have no real intention of paying back their debts in full, neither now nor in the future. This is not a trap. It is an economic approach. When we take a loan, we are expected to repay the principal. But states treat debt like a subscription. They close old debt with new debt. Economists call this refinancing. The real profit lies in interest. It is a kind of rent paid in exchange for stability. The global economy now depends on this rent, like a shark that must keep swimming to survive. If the debt cycle stops, the system inevitably collapses. The United States will never fully pay off its $38 trillion of debt. Japan has been rolling over its debt for years. It now exceeds 250% of its GDP, yet interest rates remain near zero. Investors do not demand their money back. They demand a renewal of the arrangement. Why? Because government debt is considered the most reliable asset in the world. A U.S. Treasury bond is not merely a debt. It is, in a sense, money itself. Pension funds hold it. Banks use it as collateral. Central banks count it as reserves. If the U.S. government truly tried to pay off its debts, a thought that itself borders on disaster, the global financial system would lose its most fundamental asset and collapse. That is why countries do not reduce their debt. They keep increasing it. Debt is the rhythm of capitalism. Political promises to end the debt are the most beautiful yet most meaningless lines in the story. The goal is not to eliminate debt entirely, but to balance it, to keep it sustainable, and to ensure it remains in demand. Because when confidence disappears, the numbers lose their meaning, interest rates rise, and the economy stalls. This is the true nature of sovereign debt. The plan was never built on paying it all back. The real plan was to keep everyone believing that one day it could be paid. This is a cycle of trust. As long as trust exists, the numbers can grow without limit. But trust is not evenly distributed across society. The phrase, "we owe it to ourselves," is not entirely true. Interest payments do not circulate equally. They flow from workers and taxpayers to those who hold the debt. That is why global inequality rises hand in hand with global indebtedness. The system rewards those who hold debt and punishes those who pay it. If this feels familiar, the reason is simple. The story is the same, from family budgets to nations, and from nations to the entire planet. Lenders are not necessarily villains, and borrowers are not simply victims. Both are parts of the same mechanism. Risk appears when the engine's fuel begins to run low, when new debt can no longer carry the weight of old promises. That is when the question, "Who is the debtor?" stops being abstract and becomes painfully concrete. At the top of this pyramid, there is no single face to blame. Not China, not Wall Street, not the IMF. All of them and us. The modern financial system has turned debt into money. Governments issue debt, banks expand it, investors buy and sell it, and the public believes in it. Once, debt was like a chain. Today, it is a form of balance. But if that balance is lost, if confidence shatters, the fog lifts, and the true nature of debt is revealed. A promise that cannot be kept forever. If this narrative has given you a different perspective, hit subscribe.